Good morning, ladies and gentlemen. We want to thank everybody for taking some time out of your busy schedules, as always, to meet with us, to do a little bit of training. And we're very excited to have our Regional Vice President with AIG Annuities on the line, Mr. Charles Samuel. Charles, thanks for your time and taking the call today. Just excited about this opportunity. I think it's for specifically for New York, but also in really every other state. We have some really competitive income annuities with AIG. And then, like I said, just specifically in New York, I think that this is a big opportunity because we don't have any other products like the ones that Charles will speak about today in New York. So, and in every other state, the payouts on these income riders are very competitive. I will say, because I compare these every day with all the products that we have. So, without further ado, just a little bit of background, and I'll sort of introduce Pinnacle and then pass things to Charles. But obviously, my name is Josh Horton. I'm our Assistant Vice President, run our annuities, life, and long-term care here at Pinnacle. So anything that's not Medicare, as I say, just because that's a big part of our business, you can reach me, and I'm happy to help with your business. So there's my extension 7707. I'm an agent myself. Since I got right out of college, been in the business in the Philadelphia area here. Was a New York Life agent for a number of years until I came over to the brokerage side working with Pinnacle. So I mention that just because I've been in the field and still have my own practice here, and just definitely have been there and seen a lot of the different things that you encounter as agents out there. So when I'm looking at products like these AIG annuities, looking at them in terms of how would they be applicable to our clients, and how can our agents offer solutions to clients that really will improve their situation, and how can our agents generate more business. So, if you need help in those any of those arenas, extension 7707 is me. And before I pass things to Charles, just a little bit on us here at Pinnacle Financial. If you're not already working with us, we are an independent brokerage firm. We offer a wide array of different products, really sort of designed for the senior market in general. We definitely deal with some underage clients as well, but a lot of the solutions that we have are engineered for your retirement type clients. So that's your life insurance, annuities, long-term care, senior health care, MedSup, MedAdvantage. And we offer really all top-level contracts. They're all direct contracts to the insurance company. So if you write one of these AIG annuities, whether it's the Power Index Premier we'll talk about today, or the Assured Edge that we'll talk about as well, you're paid by AIG. So you're vested with them. If Pinnacle closed its doors for some reason, you're still fully vested in AIG's eyes. And it's important, I think, as independent advisors out there to mention that. So we do really everything from start to finish with our agents. That goes from helping you find new clients if you need help with marketing, lead generation, or just a way of getting in front of new prospects. I always think that's really kind of the hardest part of our job, so we can help you with that. If you're proficient there, then if you just need some assistance with your annuity business, with your life business, we really do handle everything from start to finish. So if you need help with case design, picking the right product, running illustrations, we can do that here in-house for you, or we can provide you with training on how you can do that yourself. And then once you've written business, if it comes here, we will scrub that application. We try to make sure everything is filled out as best we can. And my staff here, they know what to look for. They're very proficient in checking those applications and know exactly what's needed on all the different annuity applications. So if this might be a newer topic for you, just rest assured you'd have sort of an extension of your staff here in us here at Pinnacle that would help you all along the way, even all the way down to making sure you get paid the right amount at the end of the day. So with that said, I want to pass things off to Charles, and AIG is one of our premier partner carriers. We love working with them on the life and the annuity side of the business. Without further ado, Charles. Thanks
All
for
right.
jumping on today.
Oh, thank you, Jay, for having me. I always enjoy working with you all because when you have someone that is not just a marketer, but a person that's been in the business, you're going to get and you're going to hear things from a perspective that you may not hear from otherwise. And I can tell you that there was a point in time where I was in the field too, and having the right partner, I'm like it's when you sit at that kitchen table and you're talking to that client, it's not about what you do in that moment. Like you can close them, but it's all the other things that have to take place before and after that moment that will determine the success of your business. So also being a producer back in the day and now being with the home office, I understand and I feel your pain. So as we go through the presentation today, I'm going to present this not as a talking head with AIG, but eyeball to eyeball with you all. And what I want to do is I want to encourage you to challenge me along the way. So if I say something you don't agree with, challenge me. That being said, let's get right into it. It's been a very volatile year for fixed income assets. Like that was a headline for last year, not so much this year, but there's always going to be some volatility in the marketplace. And when it is, people are like the guy in the picture. He's holding his head. He's trying to hide the fact that his hairline is going backwards. I love the headline there. It says bond and equity slump leaves investors with nowhere to hide. And in many cases, when the markets are going great, everybody's like, yay, the market's going great. And all of a sudden, GameStop does something stupid. They're like, what is happening in the market? And they're afraid. What do we do? Typically, when all these things are going on in the market, especially in our current environment, people have traditionally, they've gone to places like money market, CD, the 10-year treasury. Now, these dates are current up to 2020, and some of them have changed. But when you think back to 2007, and if it was a bad time to be in the market, you're afraid to be in the market, you didn't want to necessarily go into bonds, right? To go into bonds, what did you do, right? You went into the money market. And if you went into the money market, you could get 3.3, not bad. Or you say, no, I don't want to go into money market. I'm going to go into 5-year CDs. 3.73, not bad. And if you did want to go into bonds, 10-year treasury, 4.04, not that bad. This was just 13 years ago, 14 years now. 14 years later, if you were to go to the money market, what is the money market paying today? Scary to think what you're getting paid in the money market today. It almost feels like you're going to the bank and getting robbed, right? 5-year CDs. I asked the question today. So what is a 5-year CD paying today? And people like maybe 1%, depending on where you go. So you're going to leave the money with the bank for 5 years and not have any access to cash for 1% or less? Does that make sense? And a lot of people are saying, no, it doesn't make sense. And when you think about the Power Index Premier in New York, traditionally, the objection that I've gotten from my New Yorkers is, Charles, we love equities, we love variables, we love stocks, and now you're talking about this index is tied to the S&P, but your cap is 4.25. That's nothing. And then I say, I'm not trying to beat the market. We are trying to beat the bank. Your client has money sitting in the bank earning less than 1%. And the Power Index Premier in New York has a guarantee of 1%. And right now, for over $100,000 on the S&P, it has a cap of 4.25. That, if you can't see the value in that, you guys need to hang up now. But for those that do see the value in that, they'll also understand that the 10-year treasury is no longer at 4%. Right now, I think it's a little above 1, right? And the 30-year treasury is higher than that. But at the end of the day, does the client want to be in a bond in the current environment? Which brings us to our next conversation, right? Typically, if a person didn't want to be in stocks, they wanted to be in bonds. Bonds had and I don't know everything about bonds, but the guys that I know have said, Charles, bonds have just really closed out a 40-year bull run. Unless the interest rates go into negative territory and we start hitting this rising rate environment, people that are buying these bonds are going to get crushed unless they hold these bonds to maturity. Which brings up another question. Are your clients willing to take on additional risk for more growth and income? And the answer is very simple. No, 91% of clients don't want to lose more than 10% of their assets. They're willing to take some loss, but not a lot, especially as they're approaching retirement. 30% of clients surveyed said that no losses are acceptable. So in this environment where there's a lot of volatility, where banks and the place where people would traditionally go for safety aren't giving them the returns they're going to, and bonds might not be the place to go for all of their money, especially not now, then what options do you have in New York? And we're happy to say that the Power Index Premier is one of these solutions that is starting to stand out. As a matter of fact, almost every week now, I'm getting calls from people saying, Charles, I have a client and they want to know how much will you take? Like, what is the maximum amount? And I have to tell them, well, the maximum is $1 million without home office approval, and then over $1 million, we can take up to $3 million, I've seen, without cutting comp. Very rarely are people saying, so what's the minimum premium on that? But if you're wondering, it's $25,000. Now, we'll go over the issue ages and all that good stuff later. But when you think about this solution, there are two things that come to mind. This solution has two sides. There's an accumulation side where we're going to try to beat the bank and grow your money. And there's also the income side. You know, many people today, they're more afraid of running out of money in retirement than death. They'd rather be dead than broke. And this is the only solution in New York that's an index a solution that has an income rider. And there are other variable solutions out there that are great solutions that have income riders. It's going to cost you more than it would here, and we'll walk you through what this solution looks like from an income and accumulation standpoint. But first, we're going to talk about accumulation. Protect and grow your clients' assets with the power of one, right? A lot of times when you're outside of New York and you're looking at an index annuity, it's the power of zero. But New Yorkers are like, forget about it. We want to guarantee 1%, and we have that inside of New York. Now, it's structured a little differently than you would typically see in the past. On this solution, when we introduced it last year, we introduced a new column called the minimum accumulation value. It's very important. Take note of that. Minimum accumulation value. Typically in New York, when you're looking at the illustration, and we'll take a look at that later, you're just looking at one column, the contract value. That's the only column that mattered. Not anymore. Now it's the contract value column and the minimum accumulation value column. Both of those columns are important. For the first 6 anniversaries, those columns may not match, but your client, if they are deciding to take out income or to walk away from the contract, they want to surrender the contract, they will benefit from the higher of the two. At the 7th year, there's going to be a reset, and we're going to look at the MAV or the contract value. Whichever value is higher, if the contract value is higher, the MAV will step up to the contract value. If the MAV is higher, then the contract value will step up there. We'll show you on the illustration what that looks like. And from that point forward, your client will get the guaranteed 1% or whatever the market does. And we're going to show you what that looks like throughout this presentation. And also at the end of the presentation, we slow down and go over some of the other tools that we have for this solution. So great, you got a guaranteed 1%. How are you going to grow my money, Charles? What are you guys using to grow the money? Great, I'm glad you asked. We have 3 indexes. We have the S&P 500, the Russell 2000, and the MSCI EAFE. So we have U.S. stocks, U.S. small cap stocks, and international represented. Then people always ask, well, why do you do that? Why can't you just leave it with the S&P? Well, we did that at first, and we added these 2 other options because there's not one market that's always going to win. And so by having this diversity, it gives your client a wider range that will allow them to accumulate money within the product. Great. So we have 3 indexes. How are we measuring these indexes? We are measuring these indexes on an annual point-to-point basis. So we're looking at this point, and we're waiting a year, looking at this point, and we're saying, what happened, right? And in this example, the market went up 7%. We're applying the cap of 4%, and the client gets 4% credited to their contract. Now, we have a rate sheet that will show you what the caps are for the accumulation version versus the income version. And with this solution, it's banded over and under $100,000. So depending on what your client gives you, we can give them a higher cap, or if they have less than $100,000, it'll be a lower cap because they're bringing in less than $100,000. Now, I like this page because on this page, it outlines clearly what we have from the contract value, right, and the MAV. And what I'm going to do is I'm going to annotate this slide because I want to really drive this point home for you all. So we have the contract value here. We have the minimum accumulation value here. And let me see if I can change that color. Let me see if I can choose. Yep, there we go. Red. Okay. Now, when you look at this in year one, the client gives us $100,000. It goes to their contract value. It also goes to the MAV. I was telling you that there's that 1%, right? That's tied to the MAV. So, for the first 7 or for the first 6 anniversaries, what you're going to notice is the contract value and the MAV may be different, right? So year one, what happens? The market goes up 12%. You're getting 4%. You're beating the bank. I'm trying to tell you, you go from 100,000 to 104,000. Great. Now your MAV is guaranteed to grow by 1%, and it may not be the same as the contract value for the first 6 anniversaries. So now the contract value is 104. The MAV is 101. Now that continues until you get down to the 7th anniversary. Now the 7th anniversary, that's when that step up takes place. So we go from the contract value goes from 117 to 121. The MAV goes from 106 to 121, right? Why does that happen? Well, in the 7th year, the market went up by 9%. There was a cap of 4%, so the value went from 117 to 121. The MAV was guaranteed to go to 107. It was guaranteed to do that, right? Because you have that 1% growth. But because the contract value was higher, bam, now the client gets the higher value. Now from this point on, whatever the market will, the client will get the better of the two. Whatever the market does, or the 1% guarantee, whichever is higher. The next year, they're getting the 4%. The next year, the market doesn't do anything, but the contract value still goes up. Why? Because you have that guaranteed 1% growth. I know I gave you guys way more than you probably needed for this particular section, and you're not going to have to go over that with your client, but I always want to try to make sure you understand that when you look at that guaranteed 1%, you're looking at the MAV column. And when you're looking at the first few anniversaries, it's going to be different, but after the 7th anniversary, it's going to be the same. So it's going to be the contract value and the MAV will be the same going forward. Now, I'm going to pick the right tool again and continue with our presentation. So I like sharing a story at this point because now we're going to start transitioning between the accumulation side of this contract and the income side of the contract. And I love my New Yorkers, and I was talking to a stockbroker, not a current stockbroker. He spent some time as a stockbroker. And when I told him the cap was 4 1/4, he was like, Charles, he yawned. He's like, are you serious? 4 1/4? What idiot would do that? You know, he's a New Yorker. I was like, by the time we finish this story, you're going to be that idiot. He's like, all right, Charles, all right, show me, tell me something. And I said, do you remember the lost decade? He's like, yeah, I remember the lost decade. That's when I was doing my thing. I said, great. I said, during the lost decade, imagine your client gave you $100,000. And at the end of 10 years, you gave them back $95,000 after 10 years. And he said, Charles, I don't have to imagine that. I've lost a lot of money for people. And let me tell you, when you lose people's money, you have to go back. You have to swallow half a bottle of aspirin before you have that conversation. It's painful. And I hate it just thinking about it now. And I think back to that same example. Client gave you $100,000. A decade goes by. During the same time where you could have given them $95,000 back, you're coming back and you're giving them $137,000. $37,000 more than what they gave you in a period where some people would have gotten back less than what they gave their broker. How would that make you feel? He's like, Charles, man, I gotta be honest, that made me feel pretty good. I said, that's the value of using index annuities. I'm not saying we're better than the market. And if you look at these returns, some of these returns are very impressive. What I am saying is for some clients, it's a great solution to take the risk off the table. It allows them to diversify their holdings, and it allows them to beat the bank. Now, we're going to transition into the lifetime income builder, which is the rider version of this product. And if you have any questions along the way, please feel free to drop those questions or comments in the chat, and we can address those. But as we transition into the lifetime income builder, there are three things that you need to be thinking about with the lifetime income builder. Maybe you're familiar with income riders, and maybe you're not. When you're thinking about an income rider, there are a few elements that work with an income rider. The first thing that's very important with an income rider is the withdrawal factor. And on this product, we have withdrawal factors that go all the way up to 5.9%. Then people say, well, how is my money going to grow? Well, every year, if the client decides to wait before they take out income, the withdrawal factor, the initial withdrawal factor, grows by 15 basis points. Then, so let's say the person waits 5 years, right? Then the withdrawal factor went up by 15 basis points each year, and the underlying accumulation factor was guaranteed to grow by 1%. And 5 years down the road, we're basically going to say, okay, what is your withdrawal factor? What did it grow to? And what's the current cash value? And that's going to provide your client with their income for life. But what are some of these withdrawal factors? You know, this is a grid that kind of walks you through some of the withdrawal factors, and it even gives you an analogy. Your client is 65 years old. The initial withdrawal factor for a 65-year-old single individual is 5.15%. They gave you $100,000. You could give them a guaranteed $5,150 for life. For some people are like, that's not a whole lot. But if you're looking at a safe money withdrawal rate, typically people would say that was 4%. So it'd be $4,000. That's surely not a lot. And then now if you look at the new safe money withdrawal rate, some people would say it's closer to 3%. So $3,000, that's not a lot. And there's still a chance they could go to zero. So now we can give them almost twice as much as the safe money withdrawal rate. And we can guarantee that they never have to worry about going to zero. And then if that person wants to wait, what does that step up look like, right? This slide kind of walks through for the same client, they're 515 at issue, but if they waited a year, it's 5.3, right? Waited 5 years, it's 5.9. And then on this slide, it kind of shows you, so it's 5.9, the underlying value grew by at least 1%. So now the accumulation is 105, 101, and if we multiply the two together, that would have given them a guaranteed lifetime income of $6,201, right? And that's when the client is 70 years old. Now, this next page kind of goes over, the income rider and how it works. But instead of using this page to have the conversation, I like to just close out the presentation here, see if you have any questions, and then take you on to the illustration and the other tools that we have to make it real so that you can see it. And from there, I'll show you, this is the Power Index Premier accumulation, this is the income, this is the MAV information we talked about. Here are some tools that we have. And as we close out, I could talk about the Assured Edge, because the Assured Edge is very simple. It's just an income play. For the Power Index Premier, it solves both problems, accumulation and income. So I'm going to stop the screen sharing. Jay, were there any questions from any of the participants that we have?
Yeah, great stuff, Charles. We did have, looks like we have one question. So if you guys have any other questions, don't be shy. We've all done a lot of these webinars the last year or so, so we want to hear from you. I had a question about the income payouts, and the question was, so this income rider doesn't have a set roll-up percentage. It has to do with the payout percentages. So can you address that one?
Absolutely. A lot of times when you have these income riders, there's the cash value, then there's this income base, right? And it's different. And then there's a cost. There's a cost that's basically measured on that higher value, and then it's subtracted from the cash value. With this contract, there is no income base, right? So what's growing is the withdrawal factor, and so the withdrawal factor is growing, and then we're going to multiply that withdrawal factor by the accumulation in the product, and that's going to provide the client with lifetime income. Great question.
Got it. Got it. Yeah, that was the only question so far.
Good. So this is the playbook that we have for the Power Index Premier. And one of the things that, and I'll walk you through just what you're looking at on this particular playbook. On the left-hand side, that's all the consumer approved information that we have. The bottom left-hand side, you're going to have the static illustrations. On the right-hand side, you're going to have Knowledge is Power website that has client approved information. The product guide that will walk you through all the other details of, okay, the issue ages for the income product is between 50 and 80. Issue ages for the accumulation is from 18 to 85. And all that information will be in the product guide. The one thing that people always like me to focus on is the placemat, because when you have the placemat in front of you, it's almost like having 200 different illustrations right at your fingertips. And so I'm going to show you the placemat because it'll also help me to answer the last question that was asked around, you know, how does this thing work? How does it grow? And then from there, we'll go to the illustration. So when a person is coming into my office, and Josh, if you don't mind, just throw out an age for me so we can show everyone how to use this placemat.
Let's do 65.
65. So the client is 65. The initial income payout factor is going to be 5.15. And for every year, right, at every anniversary when they wait, after the anniversary, that withdrawal factor is going to go up. If they waited until, you know, after the 8th anniversary, the withdrawal factor would be 6.35. And we would multiply that withdrawal factor by the cash value in the contract. And that would drive the client's income for life. Now, some people will say, well, where does this product really win? And I asked the question, when do most people, you know, if a person comes to you today and you're talking about income riders, typically people are very excited when they hear 5 for life. But typically you don't get a 5 for life payout until you're 65. Well, we give you a 5 for life payout on this product as early as 64. And on the Assured Edge that we'll highlight later, we can give you a 5 for life payout as early as 58. Now, the Power Index Premier is available only in New York, and the Assured Edge is available inside and also outside of New York. And then the other thing that people want to focus on, we're talking about this product, is the illustration. And they'll say, Charles, I need you to walk me through the illustration. What does the illustration look and feel like? At the very bottom, we have static illustrations that are on the playbook. They don't have the current rate, so if you want the current rates, you'll have to get with Jay, and he could get you those new illustrations he'll request them from us. Or if you're contracted with AIG, you can go on our website, and then you could run those illustrations for yourself if you prefer to do it that way. But when you look at the illustration, I like the way that it's laid out. The first page that you're going to see, for some people, it may scare them because it has all zeros. I was told you always start with zeros. You take them to hell and you bring them to heaven, right? You want to show them the worst case possible, and then you show them the upside potential. Now, what I'm going to do on this one page is I'm going to walk you through the contract value, the MAV. The next page I'm going to show you that's powerful is going to show you, okay, what was the contract value and the MAV when we apply past performance, right? So this is all zeros. The next page will have past performance with a 30-year look back. The last page I'm going to share with you on this illustration is going to be the best and worst 10-year period. And each time I'm going to highlight the contract value, the MAV, to simplify that conversation for you. So if your client asks you any questions, you can answer those questions, and then we'll go from there. So when you look at this, I'm going to go ahead and I'm going to try to use my pen again. Another 5-star tip, if ever you're doing virtual meetings for your clients, it may be good to make sure you're using annotations, because when you have a page like this, there's a waterfall of numbers. It's kind of hard to make sure you all are on the same page. And by having the appropriate annotation, it can help with that. So we're looking at the contract value. We're also looking at the minimum accumulation value. Now, once again, this is showing if the market does nothing. People have said, Charles, the credited interest shows 0. It should show 1 right there. I say, no, it shouldn't, because it's showing the market does nothing, so the credited interest rate is nothing. But you promised me 1%. I did. Slow down, right? And so when you look at the MAV column, that's where you're going to see your 1%. And so the contract value until the 7th anniversary is $100,000 because the market doesn't do anything. Well, Charles, that's not fair. In New York, you guys have to give the client 1%. Where's the 1% guarantee? You can really see that highlighted in the fifth and 6th year, because when you look at the minimum accumulation value, it's 105. The contract value is 100,000. The cash surrender value is 101. How is the cash surrender value higher than the anniversary value? Well, because it's the minimum accumulation value. And if the client wanted to surrender the contract, the surrender charge is applied to the higher value, and the client benefits from that. The same thing would apply from an income standpoint, and we'll illustrate that later. Then what you're going to notice is at the 7th anniversary, what happens? Now the contract value steps up to the MAV. And from that point on, the contract value and the MAV are one and the same. This situation that you're looking at right here is highly unlikely that the client's going to have 0 across the board. However, even if you look at what a person has in a CD today, if they had this in a CD, you're showing them the worst case is their best case if they're looking at a 5-year CD. And with the 5-year CD, there's no liquidity. With a 5-year CD, there's no access to lifetime income. So you're beating the bank from an accumulation standpoint, and you can give your client access to lifetime income. Now, the next thing is, what does it look like when we're factoring in some past performance? So we're going to go ahead and do that. We're going to factor in some past performance. And for illustrative purposes, we're looking at a cap of 3%. And I'm going to do the exact same thing and walk you all through that. So now we have the minimum. So we have the specific period, right? We're looking at 1989 through 2019. We're looking at the minimum accumulation value. We're looking at the contract anniversary value. And out the gate, boom, you know, the index doesn't do anything 2 of the first 7 years, right? So the values are going to be different for the first 6 anniversaries. At the 7th anniversary, what happens? The contract value is 115. The MAV steps up to 115. At this point, some people will say, Charles, so that 1% guarantee thing, that's only for the first 6 anniversaries. No, it's not. Well, show me where I get the guarantee 1% past the first 7 years, past the first 6 years. Then I'll draw their attention to years 11 through 13, where the market didn't do anything. But what happened to the contract anniversary value? It continued to grow. Why? Because after the 7th anniversary, the client is guaranteed to get the better of 1% or whatever the market does. And this is how we illustrate that on the page. We're showing the look back for the last 30 years. Now, the next thing I'm going to share with you is when people see this. Did you have any comment, Jay? Did you have I don't know if you had. Okay, good.
I did. You know what? We had a question. I could jump in and pose it. It's kind of.
Sure.
I want to break the stride. It's they were just one of the agents asked if you could add additional money in the first year, and also additionally single premium.
Single premium. It's not flexible premium like, yeah.
And can they take excess withdrawals early? Like, is there a 10% annual withdrawal? Or?
You can. That's an option. So if a person is asking me that question, and I'm the agent, and I'm sitting across the dining room table from them, or the kitchen table, or in our new environment, this virtual space, then I'm going to say, you know, you're asking if you want to take 10%. Depending on the client, I may not use the income rider. right? Because they're saying they want to take out 10%, that is going to have an impact on the income rider. So for that client, I just may say, we're going to buy this annuity. We're going to just go with the accumulation chassis. From year one, you buy the product. From the first year, you have access to 10%, right, of the contract value going forward. But then if they're focused on guaranteed lifetime income, then that's a different conversation, right? But if they say, hey, I just want a place to park my money and have access to 10%, they could do that. If they buy the product with the rider and they want 10%, they could do that. However, I'd say that's going to have an impact on the rider. So it'll be a proportionate reduction in their income going forward. So my question would be, instead of taking out 10% here, is there another source that they could take 10% from? Because if we're getting guaranteed income here, we really don't want to mess with that, especially if we're getting the maximum amount of guaranteed income that's available. Now, this last page that I'm going to focus on before I transition and close out, we can answer any more questions to the other product, the Assured Edge, it's available everywhere, is I like this page because it really, if I were to sell this contract and I'm selling this from an income standpoint, this is the one page I'm looking at. Why is that? Because I could say, Mr. or Mrs. Client, we're looking at this from the most favorable period of time and also the most unfavorable 10-year period of time. And if you were to give me your money today and you wanted income in the third year, now this illustration was run without withdrawals coming out, but if you wanted income in the third year where you are now 63 years old, right, we have the minimum accumulation value and the contract value, where in this situation, the contract value is 106, the MAV is 101, and we're generating an income of $5,411. So what are we using to generate that income for you, Mr. Client? In this situation, it's the contract value because it's the highest value. Now, at the bottom, looking at the same year, year 3, where the client is 63 years old, we have the contract value here, we have the MAV here. Now, in this situation, Mr. Client, Mrs. Client, the market didn't do anything for the first 3 years. Now the contract value is 100,000, but the MAV is 103. Well, in this situation, Mr. and Mrs. Client, because of that guaranteed 1% that we're talking about, right? You're at a minimum, your income is going to be guaranteed at $5,255. So the range of income that you can expect on this product, based upon this current illustration, will be between $5,411 and $5,255. And when people get to this page and we go over it this way, they're like, why didn't you start here? I said, because if I would have made it this easy, you would have asked me really difficult questions that I would have to go through all the other stuff in an illogical way to answer to get to this point. But typically when I walk through it this way, people get it, they understand it, and we don't have any objections. So at this point, I'm going to pause to see if there are any questions. And then if there are no questions, then I'll go ahead and I'll cheat over to something that's very simple as it relates to the Assured Edge to show the power of that for clients that are looking for the maximum amount of income and they're not really focused on accumulation.
You know what, Charles? It looks like we had an individual raise their hand. I don't have it set up that way. If you had a question, the person that raised their hand, I would say go ahead and type it in, or if you had a comment, either one is great. We'd love to hear from you. We did have a question about commissions, so that's a great question. We always get those questions. You know what? As far as commissions go, we're very transparent. We'll tell you exactly what you'll earn on this, but it's better to speak about it after the fact. It's because we have a couple of agencies on the call that their agents get paid a little differently. So, but great question. That's I would say a good sign, Charles. You know, interested in commissions. But, you know, maybe they have a case. So that's great. We'll talk definitely afterwards about the comp. And that actually makes me think of I always bring up on these calls, and I should have said this at the beginning. If you have any prospects or clients that come to mind with this, definitely jot their names down so you don't forget, and let's talk about them. I mentioned the Annuity Rate Watch quoting, but Charles had mentioned the software that AIG has. The Annuity Rate Watch is kind of just a quick, easy tool to run quotes, but their software would be more professional. So we can get you everything that you need to go out and write one of these today. Absolutely.
And so what I'm showing you right now is the Assured Edge product. So we're transitioning. We have the Power Index Premier. It has an accumulation of income chassis. It's an index product, right, with those 3 indices. We talked about that, right? Now we're transitioning to the Assured Edge. The payout factors for the Assured Edge are going to be different than the payout factors for the Power Index Premier. And so what I'm going to do is I'm going to share with you the placemat that we have for New York, and it's different for the placemat that we have for non-New York. And then I'm not going to spend a lot of time talking about it, but I'm going to show you, because whenever I show people, you know, what this product, like the withdrawal factors, they're like, oh my God, how do you guys do this? Like how do you, like, don't worry about it, we're good. Like we're not pulling it back, and we're comfortable with this. We have some experience here. So when I ask people about, you know, what's a good withdrawal factor, many people say 5%, 5 for life. And then I ask, well, when can you get a 5 for life with most carriers? They say 65. And then I say, here's 5% at 58. What does that mean? That means your client doesn't have to wait to 65 to retire. If they're focused on, I need a little more income. If your client's a little more income, we can give them a 5% payout guaranteed for life as early as 58. And then they say, okay, Charles, but my client changed their mind. They're 58. They really don't want it right now. They want to wait a few years. Okay, if they want to wait a few years, they want to wait 5 years. Okay, so they wait 5 years. Now they're, what, 62? They're going to get a 6% payout at 62? Are you serious? Like, where else can you do that? So people say, okay, Charles, but this is a lot of math. This is too hard. I'll say, okay, let's not do that. Let's just do it this way. And this is why I love our calculator. The payouts on this product are competitive with SPIAs, especially for ladies, because SPIAs are based on mortality, right? And so this product is not priced out for male or female. And so people will say, okay, Charles, so I have a client, they are 65 years old, and that person, they want income right away, and they have $250,000. You hit calculate. Once I hit calculate, I'm telling you, right, okay, well, if that person has $250,000, which is about our average ticket, between $250 to $375, we get a lot of tickets for $1 million, or if not more. It's $14,250 guaranteed for life. What happens if the person dies before all the money's paid out? It's almost like a SPIA with a cash refund. Whatever value's left, it goes to the beneficiary. Okay, I like that, Charles. Well, can you give me something that I can send to the client? Absolutely. Well, with this calculator, this isn't a full illustration, but it will give you a one-page printout that's client approved that you could actually share with the client. You could open it up and say, okay, Mr. and Mrs. Client, you know, this is what we're going to do for you. You said you want it. You're 65. You want income right now, and you have $250,000. This is a one-page report. It's one page. And what's really important is it's showing you at 65, we're giving you a 5.7% withdrawal factor guaranteed for life. Now, some people will say, yeah, but I don't want to tell you how much I have. I don't trust you, right? I trust you, but I don't trust you. I'm going to tell you that I want money now, and I'm going to tell you that I need, let's call it $20,000 a year. I need $20,000 a year. Now, you tell me what I have to give you today to guarantee me $20,000 a year for life. And I can tell you it's going to cost you $350,877. And if they like that, you can click the print button. And once again, there's going to be that one page that's going to pop up. And every time I've done this, people are saying, you're giving me the same income that I'm getting somewhere else, and you're doing it with fewer dollars. And I say, yeah. They say, well, Charles, but I want to get paid. I say, great. So sell them life insurance. Great. Take the rest of the money, buy some long-term care. Great. If they're giving me fewer dollars and they're happy with that income, give me more income or more money and I'll give you a higher payout, right? There's so many different places you can go from here. And so one of the questions I always ask people is, or one of my counterparts always ask me, what's the right amount of money to put into an annuity? And the question is the least amount, to give the client the desired income that they're looking for. I want to take fewer dollars and give you a higher amount of income so that you could take those dollars that you're saving and put it into a holistic plan that can help you to get through your retirement successfully. So today we've covered a lot of information. I know that we did, and I apologize if we were moving at a pace that was a little too quick, but I'll go ahead and do a recap. We talked about the reasons why people are going with the Power Index Premier in New York. It's not to beat the market. It's to beat the bank. We have a guaranteed 1% floor. We have caps as high as 4.25, over $100,000 from an accumulation standpoint. Some people, they don't want to just beat the bank. They're afraid they may run out of money. And they want to have growth, and they also want to have guaranteed lifetime income with options. The Power Index Premier has an income rider that also solves for that. Then some people will say, no. I have my accumulation taken care of by somebody else. What I'm coming to you for is I want you to give me the best bargain for income. I want the highest amount of income at the lowest cost, and we're able to show you that, share that with you using the Assured Edge. That's available inside and outside of New York. And these are just a few of the options that we have on the AIG chassis. So with that being said, Jay, I'm going to go ahead and hand the call back over to you.
All right. Well, I think that's it we have planned for you guys for today. So again, just really appreciate your time. Thanks for joining us, and we'd love to speak with you real soon. So you should see my extension there again on the screen. Our website, pfsinsurance.com. If you're not appointed, that you can do it right there. You can check out everything that we have to offer on the website as well. So again, thanks everybody for your time, and hopefully we'll speak to you real soon. Thanks a lot, Charles.
Thank you.
We'll be talking shortly. All right. Take care, everybody.